The sheer scale and speed of interest rate rises in the US has led everybody to wonder, when is something going to break? Well, we already saw part of that in March with Silicon Valley Bank, but the response from the Federal Reserve to effectively provide a swap for a year has kicked the can down the road. It added a bit of extra liquidity and breathing space to the market. Then we got the debt ceiling debacle, where there was a stalemate over what was going to happen to how the US would fund itself. So that actually meant everything stood still until it was resolved. Now it's been resolved, the US can issue debt to fund itself, which, with more supply coming down the line, would tend to mean market interest rates would rise. So we're starting now to see the liquidity tide going back out. At the same time, this surge in the consumer is starting to run out of steam. The LVMH report that recently came out, they said that aspirational customers are not spending as much as they used to. They've worked their way through their stimulus checks and they're starting to row back a little bit. People are starting to be a little bit more concerned about what the future might hold, that the never-ending rally isn't going to always be there. So when everybody comes back from their holidays, that is going to be a real challenge for valuations on the US stock market. And it could well look a little bit like Wile E. Coyote, that the market has run out of road, everyone will come back from their holiday, look down and see there's a canyon down there. And the valuations do not make sense with higher for longer, the watchword of the Federal Reserve.